I would like to introduce Georgina.
Hello, everyone.
So Georgina and I have kind of crossed paths many times over the last couple of years. And it became clear really quickly, really early on, that she was somebody who actually understood how it worked as a musician trying to get a mortgage. So, I worked as a freelancer in my 20s, and my husband is a freelance musician, and we know only too well how difficult it is to do that tick box exercise that's required often in terms of getting mortgages. And it was really clear right from the beginning that Georgina was somebody who understood that and understood the kind of the world that musicians work in, and how you need to be able to think around that in order to make everything fit, and when it comes to mortgage applications. So without further ado, I'm going to hand over to Georgina and let her introduce herself a little bit more, and then we'll go to the slides and have a look at our agenda for today.
Thanks, everyone. Lovely to be here, and I hope that you'll find it really helpful. My background is that I've been an IFA, so an independent financial advisor, who's always had a specialist interest in mortgages for more than 40 years. I mean, that is scary, but I've seen all sides of it. I have a particular interest with musicians, actors, and the performing arts, basically, from personal experience and my own friendship group of people. And it's developed, and I feel that it's an area that's very much overlooked, and I'm looking to make some inroads to make it more easy for people to understand what's required of them. Doesn't mean, you can get a mortgage, you just have to know what the questions are and how to prepare. I think that's the key.
Musicians and mortgages. I think we've reasonably well covered our introductions. And let me do that. I'm going to have to be moderator and slide mover and question taker at the same time. So I hope you'll bear with us while we do that. So here we go. We're going to cover how to get yourself ready. What kind of financial information you need to pull together, how to understand, thinking about the affordability requirements that are going to go into any sort of mortgage offer that you'd hope to get. We're going to cover what's required as part of that. We're going to it's quite stringent these days with all kinds of forms, verifications, ID, and so forth. We're going to have a look at that. There's some useful links at the end, including some clickable stuff, hyperlinks, that you'll get the slides at the end of the session, as well as the recording, so you'll be able to dig in and check those. Okay, so right off the bat, let's go straight into the income and affordability. So Georgina, as a freelance musician, you know perfectly well, most of us have a portfolio of income, a mixture of PAYE and self-employed income, maybe some royalty income, some PPL coming through, perhaps a peri-teaching job. There's usually a real mixture.
It's always a mix.
How are the mortgage lenders going to look at this?
They will consider all verifiable income that we can provide them with. So the verification is the key. So if you have PAYE income, they're going to want pay slips because that's current. If it's self-employment, sole trader, they will be looking for the last minimum of the last 2 years SA 302 forms, which is the tax summary showing your income from all sources, plus the tax year overview statement confirming the amount of tax that's paid, and again checking that the tax has been paid and that you don't have anything outstanding. They would tend to take an average of the last 2 years self-employment net profit. So that's your turnover less your expenses, but before tax. And there are some lenders, and this is where you need sort of specialist advice on an individual basis, but finding the right lender for you. But there are some lenders who will look at the most recent year's figures if it's been increasing and it looks as though it's sustainable. And they will certainly look at the PAYE income as well. So that can all be added in. Rough rule of thumb, Forget what you've heard about people lending you up to 6 times your income. That's not the case with the self-employed, I'm afraid. It's going to be around about 4.5 times your total income, whether that's if it's on a single life basis, that's your income. If it's a joint mortgage, it will be 4.5 times the joint income. That's the starting point, and then they will factor in things like existing financial commitments, credit cards, loans, repayments, and all of that. Because at the end of the day, the lenders are making sure, they have to make sure that your income is sustainable and that they are being sensible and in terms of the amount of the lending. The last thing they want is to overextend you so that you end up with a problem making repayments going forward. Things are slightly different if you are on a limited company, which is something that we've Sinead and I've talked about, and that is, if you have a limited company, you need to have been trading for 2 years, really, because they will look at 2 years worth of income. They will take the normal assessment is PAYE income as a director plus any dividends that you pay yourself.
Right, I'm going to jump in here and just talk through some of that terminology a little bit, if that's okay. So I suspect that for many of you that have joined today, and probably those that will be listening in the future, a lot of you in the earlier stages of your career are more likely to be trading as sole traders, self-employed anyway.
Likely.
And when we use the word turnover, we mean income, just straightforward income before expenses. But one of the key things you have to be aware of, it applies to both your tax return and to this sort of scenario where you're setting out your income for somebody else. As a musician, you don't generally distinguish between the income you earn as true self-employment, in other words, totally as a freelancer, and the income you earn as a musician, but that might be PAYE. So for example, if you're teaching 1 or 2 days a week and you're on a PAYE job for that, in your mind, that's all just income. But you need to distinguish between the fact that for a mortgage application, your school teaching job is PAYE income. So they're going to be, we'll talk in a bit more detail in a minute about the actual pieces of paper they're looking for, but that's P60 pay slip type stuff. Your sole trade, which is your self-employment, is, as Georgina said, it's your turnover, which is your income before expenses, less your expenses, and then they're going to be looking at your net profit. So that is the amount that has gone into your tax return, essentially, and been taxed as self-employed income. And then I think from the point of view of the company income, that's that's a little bit more complicated and sort of specialist. And we have a couple of slides at the end on that. So I think let's move on from that for now, and we'll leave that separate. So maybe we can just speak a little bit about what you need to be thinking of in terms of having money available to go through this whole process.
Yes. In addition to assessing your income, they will be looking at your your monthly expenditure, and you will need some other considerations in here as well. You will need to have a deposit. Now, at the moment, I would say the average that you would need would be 10%. I mean, there are some lenders who are advertising 95%, but rule of thumb, you need about 10% to get a decent deal. Now, that deposit can be from savings. It can be a gift from family. If it's a gift, we may need some confirmation from the donor of the gift that it is an actual gift. But you will also need certain to cover certain costs. So that's going to be legal fees, because you'll have to instruct a solicitor. You may need to get a survey done on the property that you're buying. That's an upfront cost. You are also going to potentially have to pay some amount of stamp duty, which is a big topic at the moment, because there is a special concession the present time, which ends on the 31st of March. So anyone looking at this now who hasn't even started the process, I think we have to assume that you wouldn't be getting the level of concession that you have at the moment. After the 1st of April, what it means is that if you're buying a property that is less than 500,000, you don't have to pay stamp duty on the first £300,000 of the purchase price, as long as you're a first-time buyer. So if you're a first-time buyer, you get that concession. Everyone else, the stamp duty starts at 125,000, and there's a link to a calculator on here so that you can calculate what the stamp duty would be. So in addition to your deposit, which is what you're going to put down, that's your contribution towards the purchase, the rest of it will come from the mortgage, you do have to have those additional costs covered. How long is a piece of string is the answer to how much do you need to have, because it will very much depend on what you're buying and however the purchase price, etc.
Great. Now, I've just checked on my phone. I'm going to keep an eye on that for any questions in the chat. So if you do have questions for now, let us know and post them in the chat. And in a minute, I'm going to nip off and get headphones so that I can actually, we can hear your question, and you can come off mute and ask it if you want to. But in the interim, if you're stuck on anything, put it in the chat for us and we will come back to it. Okay. And then last but not least on this page, we have a little bit about debt and credit management. Do you want to speak a little bit about that?
One of the biggest problems that we come across with people who are first-time buyers, for example, is that they're always concerned that because they might not necessarily have credit cards or have had a mortgage before, that they won't have a very good credit rating. You don't need to have credit cards and loans in order to get a good credit rating. And as long as you are visible to the credit agencies, so that means if you make sure that you're registered to vote and you're on the electoral roll where you live, you can provide a 3-year address history, which is what they will look for with dates and full postal addresses. They will find you. There are various offers around that you see where you can boost your credit score, and that generally means you subscribing to one of the credit agencies and giving them a link to your bank account so they can see how your bank account is managed, and that might be able to boost your score. However, it does come at a cost, and I would say that the only time I've ever needed people to go in and check their credit rating would be if they'd had any situation where they'd perhaps forgotten to make a payment or got into some trouble. And you can certainly check that yourself without having to pay an annual subscription by just signing up for a 30-day free trial.
Yeah, and we are going to talk about that as well in a little bit more detail as we go further on. And there's a couple of links about places that you could sign up to have that. So in terms of your planning around what is likely to be the affordable amount that a lender is going to consider for you, Georgina has very kindly pulled together this budget, and it actually goes across these 3 slides, but we will look at them in a bit more detail one at a time. I think the critical thing that we are going to want you to understand is the distinction between, and Georgina is the one who's going to explain this properly, but there's a distinction between essential outgoings that the mortgage lenders are going to need and want details of, and what they would say, is it safe to say less essential or slightly more flexible things. This budget planner has both, because obviously in real life there is spending that goes out that is flexible but kind of necessary. But again, over to you, Georgina, to just explain how they're going to look at those two things and largely what they are.
Well, this is a budget planner that we use within the firm for new clients, and it covers everything, and it's quite hard going because there's pages of it. But the key things are, the mortgage lenders are concerned about income that you can't opt out of. So council tax, utility bills, loan repayments, all of that, property service charges. If you're buying a flat and you have to pay a service charge, that's essential expenditure. Savings for holidays, Gym membership subscriptions are not essential, because if push came to shove and you needed to cut your costs, you could let those go. So every lender is different in how they assess it. They all use different kind of algorithms. And this is really the budget planning that we use, is usually to, as an exercise for you to actually look at what you spend in a month, because most people don't have any idea where their money goes and what they spend it on. So it's a good exercise from that point of view. And then what we do, we can extract from that the essential. Affordability is in two parts. The affordability from the mortgage lender is using their algorithms and their criteria to determine whether or not they can lend you what you want. Affordability from your own personal point of view is, what is the budget per month that you are comfortable with to spend on your mortgage and your outgoings? So if you're already paying rent, that's a good starting point, because you're already paying that. How much extra would you be prepared to pay and be comfortable paying based on all your income and outgoings to have a mortgage? And that is something that this budget planner that we produce helps people to work that out. You know, what is essential expenditure, what isn't, what could you afford?
Yeah, great. And I've had a question from Alice, who has said, typically, is the multiple in terms of affordability and lending, is it likely to continue to be 4.5 times the income? Or if you are applying in combination, for example, with an employed partner, is that likely to enable it to go up a little bit more? Or how does it work when one of you is a freelancer and one of you is employed?
It might allow you to go up a little bit, because they might be quite generous, especially if you're not borrowing a very high loan to value. So if you're coming down from, say, 90% mortgage down to 75, there may be some leeway. But generally speaking, if you've got any element of self-employment, you would probably be looking at 4.5 to 4.7, something along those lines. I believe it's a sort of the aftermath of COVID, when everyone was out of work and there was no money going out, and they just stopped lending to self-employed at that point. So they're coming back. We're pushing for them to be a little bit more flexible with it, but it's a struggle, because they're trying to be sensible and responsible lenders as well.
Yeah. And then from Samantha, I have, will they consider the rent if somebody is a lodger? I would imagine.
No is the answer to that. There is no problem with you having a lodger.
No, not the rent. Oh, actually, Samantha, we'll double check this.
Yeah.
But I think I understand from your question to mean you're not paying rent to an agency or through an agency.
Yeah.
You're renting from a private individual. So it's a bit more of an informal agreement. Yes, you are the lodger. That's what I thought.
Yeah.
Now, in that sort of scenario,
that is a source of expenditure that would stop when you had your mortgage. So they need to know that you've been making the payments, and they can look at your bank statement to see that, but that wouldn't be followed through. That's not a problem.
it's not going on.
It's not going to sort of be an issue. The only time it would is there are some lenders who are advertising first time buyer mortgages at a higher loan to value, where it's based on your having made rent payments for the last 12 months, and they take that as a sort of, yes, you can afford it.
Yeah.
And that has to be a rental contract, at a assured short-hold tenancy type arrangement that they can check.
Yeah.
So if you're just lodging, in a house share, which is what most of us did when we were, then that is absolutely fine. It's not going to go against you or anything. But yeah.
And to your question about the studio, I suspect in a scenario like that, it will really depend on whether there's any flexibility in that studio rental cost. She's also mentioning there's a studio rental. If it's absolutely vital for you to kind of generate your income as a self-employed person, then I think you'd have to argue that that is a fixed cost almost, and there isn't any flexibility. But for example, as is the case for loads of musicians, if you find yourself hoping to move into a property on a mortgage that you would then be able to use as the place of work. In other words, you might be able to fix up a little studio for yourself in your new home that is now mortgaged. Then of course the same logic applies. It means you're no longer going to be paying your studio rent, and then a lender in that sort of scenario is going to know that that's a flexible cost that will drop away and be replaced by a mortgage cost instead.
And also, I presume that something like a studio cost to someone who's self-employed freelance is a deductible or an expense. So it would come out of that, rather than they wouldn't be looking at that as a separate thing. That would just come off of as part of your expenses on your self-employment.
Which actually brings us really neatly to this aspect of kind of expenses, which are partly business related expenses, but they're also kind of personal expenses. And I'm going to skip through this budget planning just for now, because we've kind of done enough on that for a minute. But just to talk a little bit about that, as you all know, who've been trading as self-employed for the last couple of years, you'll know that some of your expenses are personal expenses, but they have a business aspect to them. So I'm thinking of things like your mobile phone, or maybe a use of a car, and things, you know, things like that. Now, historically, you'll have claimed a small portion of those costs through your self-employment accounts, your income less expenses, and it means your net profit reflects the fact that there's a certain amount of business usage of those. But nevertheless, for most people in the real world who are not self-employed, those costs are not part of anybody's business. So that can be an aspect that's quite confusing, to be fair, for lenders. And it's worth making really clear when you're either speaking directly to the lender or to the broker, how you've looked at that in the past. So that's the first thing I would say. And then the second thing following on from that, again, looking at this idea, as Georgina said, about studio rental, think of it in the context of, if it's something that's come off your income as a self-employed person and it's deemed to be an essential part of your business, then they're going to be looking at the income that's after that expense has been deducted.
They're not going to be double dipping.
Exactly. So in a way, it's quite a separate issue. Your lodger rent that we started this question with is, I think we've answered now, but the fact that you pay studio rent, in a way you can separate that, because that's a business expense and it comes off before you get to a number, which is the number you're going to be supplying to your mortgage lender in the first place.
The one that usually comes up, because a lot of lenders have a question on their applications of what are your regular travel costs. So if you're on PAYE and you're commuting into London every day for work, they would look at how much it costs you to do that. If you're self-employed, quite a lot of your travel costs will be linked specifically to the work that you're doing and be covered under your self-employment. So we wouldn't expect you to be putting £200 a month down for regular commute when it's been covered in your self-assessment.
That's really great to hear. And if anybody's unsure about that, then please do let us know, because I would say if we had to pick one thing that is the most confusing for self-employeds when they're applying for mortgage, it's that grey crossover of expenses that for PAYE people are totally excluded. They've got nothing to do with anything. But for self-employeds, they're coming off your profit before you get to your net profit figure. And sometimes it's worth saying to the lender, you know, this includes a certain amount of expenses that you would normally be kind of going, well, let's take that off before we assess affordability.
And to be fair, when you are self-employed, the key is to find a lender who is accustomed to this kind of detail and is able to accommodate it. And, you know, to a certain extent, that's my job, as you know, and all brokers, that's our job, is to know who's the best lender to use. Some of them just have an algorithm and they figure out that it's so much a month for living for a single adult, or family of 4 and they use that as their part of it. Others go into the minutiae and want to know how much you're spending on broadband and mobile phone and all the rest of it. So we always try to find the lender that is most appropriate to your particular scenario.
So that's a really lovely segue into, and because time is moving along fairly quickly, I would say a neat summary of your options when you're thinking about applying for a mortgage. Obviously, you can apply direct to your mortgage lender, or you can also apply through a broker. So, Georgina, will you kind of clarify for everybody what the distinction is of it, and a rough idea of how fees work, and what people's options are with all of those kind of things?
Going direct to the lender means that you literally go into high street or online sort of app for various banks and building societies, and they will ask you the questions. You will have to supply them with all the same information, but you're dealing with one lender of your choice, and that's all that there is. The answer is either yes or no. If you use a broker, someone like ourselves, years of experience, fully qualified, what we call open, market broker, so not linked to any one bank, building society, etc. You've got a range, and we can literally find the right match for you. Most brokers will charge a fee for the advice element of it. It depends I can only work on our own figures, which is we charge a flat fee of £395 for advising on and arranging a mortgage for you. In addition, we get paid what they call a proc fee by the mortgage lender that we select. They all pay pretty much the same, to be perfectly honest. There's no big deals going on here or anything. But what it does is it gives you clarity and a tailored service that really suits your circumstances, rather than you having to try and shoehorn yourself into the requirements for HSBC or Halifax or whatever. And part of our job is knowing the market and knowing which lenders we can rule out completely and which ones who would consider it, until we get there. And I suppose the biggest advantage of doing it is that you're all busy people, you're all working different hours and all the rest of it. Our job is to act as that go-between between yourself, your estate agent, the mortgage lender, and your solicitor, to take up all of that slack for you. It's quite stressful, but we get there.
And I think probably that's changed a lot over the years. I've had experience of both, of applying for mortgage directly, and also of being supported by a broker to do it. And I think, like everything, as the compliance, which we're just about to dive into here, all of the verification and so on, as that has become more and more stringent, maybe the argument for having more support with that has increased over the years relative to 10 or 15 years ago when I was doing it, and it was maybe just a little bit easier. So let's do that. Let's talk a little bit about the kind of identification proofs and proof of residence and so on that you're going to have to present to any lender.
There are two main areas from a compliance point of view. The first is we have to provide them proof of ID, proof of identification, and proof of current residential address. Proof of ID, generally speaking, valid passport. If you can provide us with a copy of a valid passport, that's absolutely fine. We can use a full UK driving licence, as long, with photo driving licence. And there are a couple of other things like a firearm certificate for anyone who's got one. But generally speaking, it would either usually be a passport or a driving licence. Proof of current residential address can be a utility bill, but it has to be no more than 3 months old. It has to be an original, as opposed to one that's just downloaded off the internet, because they don't trust that. So it has to be an original, and it can't be a mobile phone bill. So it'd be your gas bill, electricity bill, something like that. Other alternatives, if you're not using your driving license as proof of ID, you can use it for proof of address. as long as the address on your driving license matches where you live. And a lot of people never ever remember when they move to update their driving license. So just check and make sure. And the other thing is, if you're young, you probably won't have an issue with it. But I can't tell you how many people we've had recently where their driving licenses have expired and they haven't realised. So yeah, it's got to be valid. That's the thing. Council tax bill, and if all else fails, we can take a bank account statement or a credit card statement. It has to be posted to you from the bank or the financial institution. And again, they're very anti having it downloaded off of the internet and on online banking. Most of us bank online these days, but you can go in and request a statement to be posted to you. Mm-hmm. Usually takes about 5 days to get that. And again, if you're getting this ready and prepared in advance, then you can switch it to postal statements in advance to make sure that you've got that up to date.
Yeah, great. And the other thing, of course, is thinking of those of you who are lodgers. It often does take a bit of time to get your ducks in a row, because if you're a lodger in somebody else's home, then you won't necessarily be on
utility bill, council tax, and all the rest of it. So preparation is the key to all of this. Just that's why we do all this, to give it up front so that you know what to look for and what to sort of get lined up.
Great. And as we said, there's just a bit more detail about what has just been said. Do we need to cover non-UK passports?
Just as an aside, there's no problem at all if you have a non-UK passport, but you just are really likely to be asked to provide evidence of your right to remain in the UK and your ability to work in the UK. So that might just be your immigration status, which is now done with a share code, or you may have a visa or something like that. Not a problem, but just be prepared for the fact that you're going to have to do that.
Yeah. Great. I'm going to speak a little bit. I mean, we've actually already touched on this slide, so I think for the most part, I'll keep an eye on questions, and if anybody's confused, do please let me know in the chat, and I'll try and be a bit clearer. But just to do a sort of whistle-stop tour one more time, PAYE is where you're taxed at source for the job that you're doing. It doesn't necessarily have to be a full-time job, but you'll have pay slips, and at the end of the year, you'll have a P60. And the lender will look at your gross income when it comes to PAYE.
That's exactly.
Correct?
That will be your gross income before tax.
Yeah.
And the evidence that we need on that is basically pay slips.
Yeah.
They might ask for just the most recent month's pay slip. It may be 3 months pay slips. And the other thing that they will probably ask for is just confirmation, a corresponding bank statement showing the salary, PAYE salary, being credited to your account, because if they can see that, they don't need to apply for a reference from the employer. So that's just a quick way of making sure.
Great. And on the self-employment, again, it's your income before expenses. So it's essentially, you need to think of it as the number that has gone into your tax return as taxable self-employment.
Yeah.
The one thing I'm just going to highlight here, which is not really musician specific, but it can catch people out, is your lender will be looking for the figure that went through on your tax return, essentially, your taxable self-employment. Now, when you're preparing your accounts and putting the figures into your tax return, or if you have an accountant who's giving you a set of accounts each year, which you might have, the accounts are normally prepared with a net profit figure. But if you have capital allowances in any given year, so that might be high value music equipment or an instrument, those would be the typical things. And if you have claimed some of those capital allowances costs in any given year, that particular deduction comes off in a slightly different place on your tax return. And if somebody else is preparing accounts for you, it generally doesn't show in the initial set of accounts. So the accounts themselves normally show your income, your sort of ongoing year-to-year expenses, and a net profit figure. And then the taxable net profit is actually a figure that comes out a bit lower down after the deduction of capital allowances if they apply for you in a given year. So, for example, if you're claiming the cost of a violin or, some fancy dancy software that you've bought for music production, then just keep in mind that number will reduce your net profit even further, and it will be the eventual number that you see on the tax calculation, as opposed to the net profit number that's coming through on the set of accounts. Now, I'm conscious of the fact that that is a little bit confusing. And to be honest, if you're preparing your own accounts and doing your own tax returns, it's moot because it probably doesn't matter. You'll know what the taxable self-employment figure was anyway, and that'll be the number you're using. But if you're getting that information supplied to you by an accountant, just have a look at the distinction between those two numbers and drop me a message if you've got any questions about it. But otherwise, the key number to look for is, what are you actually taxed on in your tax return?
And the evidence that we need of self-employment on a sole trader basis is we need copies of your tax return, which includes all of these sort of allowances, etc. We need the SA 302 forms, which come either via your accountant from their own software or can be downloaded from HMRC. And that's a summary of your income from all sources. So it will include PAYE, but it will also have your net profit, taxable net profit. And then there's this thing called the tax year overview statement for each year, which again just reiterates the amount of tax that's been charged and whether or not you have paid it. And they need it to show a 0 unless it's the beginning of April and you've been very diligent and got your tax return in really quickly, in which case if you do a tax year overview statement, it will show tax owing because it's not actually due until the following January. In the current year, that is fine, but any previous years, it must show 0.
Yeah.
And those figures must tally. So, what's on the SA 302 form must tally with the tax year overview.
Now, I'm going to bang a drum on the SA 302 here for a second, because a question we get all the time from lenders is, can we have the SA 302? And one thing to just be aware of, particularly as more and more people are using software and apps to record income and expenses, and they might then be using those apps to submit self-assessment tax returns. An SA 302 is just a shortcut terminology for tax calculation. So it's like saying, could I please have your Hoover, when actually you mean your vacuum cleaner. Any old vacuum cleaner will do. It doesn't have to be a Hoover brand. SA 302 is literally the name of the form on the HMRC tax return when you use HMRC's software. But all it means is the calculation of your tax liability in that particular year. So as Georgina said, if you're using third-party software or your accountant's using third-party software, it won't be called that, but it is that.
It will be the tax summary and it will be what's generated by your accountant. It's fine. You don't have to wait for it to be on the HMRC website.
Yes.
But if you don't use an accountant, then you are actually able to go into your self-assessment account and download these various forms as PDFs, which is what we need for any mortgage.
Yeah. And if for any reason you sometimes, if again, going back to the confusion between third-party software that won't call it an SA 302, but it is an SA 302 because it's a calculation. If you really get stuck on that, you can get in touch with HMRC and ask them to send you, it's essentially their copy, and it will come on a piece of paper labeled SA 302. So, at a push, if you're really struggling to make somebody understand, or your third-party software is something that your lender doesn't like for one reason or another, then you can ask for a duplicate, essentially, copy from HMRC.
One quick thing to bring up as well is that when you're self-employed, and if with PAYE, they take the information as it stands at the moment of application. So it's current and ongoing income from employment with payslips and P60s. We're always looking historically at the self-employment. So it will be the most recent year at the moment is the year ending 5th of April 24. So the lenders now are pretty much insisting that they see copies of your bank statements for anything from 1 month to 6 months, to just demonstrate that that level of income that was shown in 2024 is still sustainable. Now, the difficulty with that is that most musicians do not get paid a regular amount of money every month. It's bit here, bit there. It can take months for payments to come through and whatever. So we always say to you, be prepared and have the business bank statements that show your income, have that available for say 6 months, because if the work that you do is more seasonal, then we can accommodate that. And that's the whole point. You know, we will ask for different things for different scenarios, but that's the reason behind it. What they're trying to do is say, is this income sustainable?
Yeah.
And they'll work on that basis.
And in the same vein, if you're trying to get things as up to date as possible, obviously we're just about to come to an end of a tax year in a couple of weeks on the 5th of April 25, at which point you could submit your 24-25 tax return.
Yes.
You don't have to get it in till the 31st of January 2026. But of course, if you come along in November 25 to apply for a mortgage, technically you're up to date with your 2024 tax return, but it would make far more sense to get on with it and get your 24-25 tax return in and have all those figures ready and available. And
the other thing is that there is actually a cut-off on it for most lenders, whereby they will take the most recent tax return, the figures for the most recent tax years, but the most recent year cannot be more than 18 months old. So in October 25, all bets are off as far as the 24 is concerned. You will need to have provided the 25-year tax return at that point.
Now, I'm conscious of the time, so I'm going to say to any of you who specifically want to know how either limited company or partnership income is assessed, if you could just drop me a message in the chat and let me know. But on the assumption that those of you who are here in person right now don't need to know that, I'm going to move on. And Georgina and I will cover that for 5 minutes at the end, and just we can tack it on for people listening later. But just so that, we don't go too far over time, unless you really want to hear it now. And if you do, give me a hands up. But otherwise, we're going to move on. Let's just before we do that, we're on to our useful links. We're almost there, but foreign income, just briefly.
Right. One of the key issues for a lot of musicians, singers, actors, whatever, is income that is paid in a currency other than sterling. That is a big deal for a lot of mortgage lenders, and there are questions on the application that say, is any of the income being used to support this application paid in a currency other than sterling? If you tick a box that says yes, I would say pretty much 99% of the mortgage lenders would not be prepared to lend to you on that basis. And the reason for that is it's treated completely differently. Now, there are lenders who will lend, and it's just a case of knowing who to go to. If you have just a few £1,000s a year, that is just random amounts that you get in euros or whatever, because you've done a tour or you've done a particular sort of contract, we can deduct that from your net profit and allow you to go ahead with it. But it is something that you do need advice on. It's to do with the EU regulations about what constitutes a foreign currency mortgage. It's a nightmare scenario, but we come across it all the time, and it is possible to get around it by just asking the question. And it's something, don't try to hide it. You'll never get away with it, because on the tax summaries, if you have paid any foreign currency holding tax for foreign income, it will be shown on there. So that's going to be a red flag to them. So talk to a broker, figure out what you need to do with it. Not a barrier to a mortgage by any shape or form, but it's just making sure that you let your broker or whoever know that that's the case.
And when we talked about this the other day, it might be worth mentioning for those people for whom a lot of their earnings are coming through in foreign currency, having payments go through your hopefully UK-based agent is potentially
one way around it. So if the payment that's made to your agent is in a foreign currency, but the agent pays it to your bank account in sterling and takes the hit for the bank costs or whatever of doing it, that's absolutely fine. But if it's coming into your account in euros and being converted into euros by your bank, that is foreign income. And that's the difference.
Okay.
If you do have a limited company or a partnership, again, slightly different rules apply, but it's not a barrier. That's the most important thing for you to know. But we just need to know about it if we're going to look at it.
Yeah, so definitely just one of those things to file away and think, right, when the time comes, if I am applying and I know I have some foreign currency, just make sure you know the numbers.
Yeah, know the numbers and don't turn down work just because you're worried about it, because it can be sorted. Yeah.
Good. So I think useful links are fairly self-explanatory. Is there anything we particularly need to dive into here, or can we just allow people to click in?
Stamp duty calculators, things like that are quite useful to know about, because that helps you with your budgeting for what you need to have in addition to the deposit. You can check it out, and the calculator, you just put the details in of a property, the date you're buying, whether you're a first-time buyer, etc., and it will tell you exactly how much the stamp duty will be.
Great. So take a look at those. And then just briefly, credit agencies, and when we did talk about this right at the very beginning, but maybe just a little recap on why you might want to use one of these and why you might not want to bother.
The key is to make sure that you know whether or not there are any issues with your credit score. I mean, if you've missed payments on something, it's likely that there will be, an issue with your credit score. It will be less than it could be. And all mortgage lenders will do a credit search. It's an integral part of the process. It's one of the first things that they do. And so if there are any issues at all, it's going to show up there. And it's bad. You may find that your mortgage has been declined because of a credit issue. So I think it's worth checking to make sure. I don't know that I would say that you should go ahead and subscribe on a monthly basis at £15 a month to check it, because if your credit score is okay, you can check that on a 30-day free trial. A lot of banking apps that are online now will also include a little thing. If you look on your banking app, I've got it on, mine's NatWest, and it says you can check your credit score.
I didn't know
so
that.
You could do it, and you don't pay for that, you can just see it through there. But there are three main credit agencies that are used. I would say Equifax is the one that most mortgage lenders use, and it's just to check your credit rating, and as long as it's not showing bad debt, county court judgments or anything like that, you should be fine. But I think it's a good idea just to check it for yourself to be sure.
And I might be dating myself here, but I'm going to ask this question just in case it still applies. But I used to be told that you shouldn't do multiple checks in short succession, because that also raised. So, for example, don't take out a phone, buy a car, and then try and buy a house all in the same couple of weeks. Because all of those will involve credit checks.
They all trigger, and they're always a bit nervous about lots of activity on your account with lots of people checking scores. However, most of us, I mean, I was absolutely horrified. I couldn't understand why there were so many entries, and it was because I was trying to change my car insurance, and so every time you apply online for one of these confused.com or whatever, you get sort of 20 or 30 checks on it, but they're what are called soft checks, so they won't impact on anything. Mortgage lender will do a hard credit check, so it will register on your account, but yes, I mean it's not the way it used to be.
About it. Great. I've had a really good question here. Why is the electoral roll such an important component of the credit score?
Because they're trying to, it's part of the credit search to make sure you're who you say you are. And it's a very simple way of checking it. Now, one of the things that we get quite a lot is that people leave university, they go off to university, they leave their main address for their bank accounts and everything with their parents, and then we start doing credit checks and things like that, and you're not on the voters roll where you live or whatever, just know that it's worth changing it to put it onto,
to just keep up to date.
Keep up to date with it.
And presumably this is also useful if you're in that situation where you're a lodger in somebody else's house and you've got, your ID and your verification and minimal access to council tax bills, or it all just builds your
just all helps.
Yeah, great. Fab. Okay, I think we're just about there. I hope you don't mind. I didn't race off in the end to go and get headphones and take people off mute. I think we've covered the questions. We've certainly covered the ones we've had on the chat. You're more than welcome to send in any other questions you might have, and we'll tackle them in the next few minutes.
I think the number we might need to change the number on.
Fine.
Yeah.
We'll update the telephone number before we send the slides out. Sounds like they might be a little bit out of date, but all of these slides will come to you, and along with the recording afterwards. So that would enable you to get in touch with Georgina again if you wanted to. And this is how you can get in touch with us again if you want to at any time. And then the very final thing to mention is we cover all sorts of questions that range from topics like today all the way through to German VAT when you go touring with a band in Germany. I mean, and we run the full gamut. So do please take advantage of the fact that you might just catch the odd thing that sparks your interest and allows you to go down the rabbit hole and check something. And that's important for you to know, either for financial, budgetary, businessy type of things, and then also obviously much more, because it's my bread and butter, tax specific. But that's how you can keep in touch with us.